Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome to the show. Today, we're going to talk about the volatility in the interest rates. What is going on? If you look at rates in the morning, you could be looking at a quarter point difference by the afternoon. So what is creating this incredible volatility that we're seeing in mortgage rates? So I'm joined today by Gary Giffen in the studio. Gary, you see this on the front lines. What are rates today, and why is there so much volatility?
You know, I was just looking at it here this morning, and you're looking at a 30-year fixed rate at 7.7% or higher, a 15-year fixed at 6.9, and an ARM, looks like it's a 10-6 ARM at 7.9. That's ridiculous. And we talk about, will the rates go down because we've got an election coming up? Will it go up? Will it stay the same? Who knows? The bad news about it is, and I have a listing that when I listed it 3 weeks ago, I had a buyer, and rates just went up a tick, and at that point they could afford it, but when that interest rate went up, they couldn't afford it, so they withdrew their offer. And that was a condo, and it did have an HOA, so that also calls into effect on affordability. So it's making it tough on first time buyers. And it's who knows what's coming up next, but it's definitely something to watch, and it's going to affect our listing climate.
So let's give the listeners an education to the bond market, because this is the single most misunderstood market on Wall Street. And this market directly impacts your real estate business. So when we talk about the bond market, we're really talking about a set of Treasury notes and bills that get sold off at auction on a weekly basis that determine the supply and demand for the U.S. Treasuries. We have a 2-year, a 5-year, a 10-year, and a 30-year. Those are the length of the bonds that are sold off. Now, the one I want you to pay attention to is the 10-year and also the 30-year. The 10-year is going to be more important for commercial real estate, and the 30-year is going to be more important for residential real estate. Why? Because mortgages are based on 30 years. And although in commercial, they amortize the loans over 30 years, they're typically due in 10 years. And that's why you want to pay attention to the 10-year. The reason that we're seeing the volatility in the rates is simply because the bond market itself is volatile right now. Typically, it's a very slow moving market, and there's not much change on a day-to-day basis. But because of the aggressive interest rate hikes by the Federal Reserve, and because the stock market is seeing all-time highs, any pullback, people rush into bonds. And when they rush into bonds, that adjusts those yields on the 5, 10, and 30 year. So if you want to track this, I'm going to give you a few ways to track it. And if you want to type in TNX, that's the ticker symbol that tracks the 10-year interest rate. And TYX is the ticker symbol that will track the 30-year. And as you'll see, the 10-year is about 4.5 right now, 4.6 almost. And the 30-year is at 4.7. So when we talk about mortgage rates being up at 7% and higher, that margin is what the lenders are earning. They're basing it on whatever the Treasury bills are, plus a margin for their profit, which is typically 3%. So that's why we're up at the high sevens right now. So Gary, where did you see, I know it's been a long climb, but where did you see that point where buyers were throwing in the towel? Was it at 6.5? Was it at 7? Was it at 7.5? Is there a certain range that you feel like that really is the top of affordability?
Yeah, it seemed like the seven, when we creeped up to the seven range, that threw in a lot of first-time home buyers. Or what it did was it dropped them down. If they were looking at a $500,000 home or condo, it would drop them down to whatever, 450,000 or less. So, they thought, well, I can afford this size home or condo. They were, and depending on what their credit score was, it could basically move them from one area to another area in their property search.
And where are buyers left to go? I have a speculation, which we're going to talk about later today. And we're going to dive into what I believe is the next affordable housing movement. But if you're priced out of a certain area where you need to be for your kids, or you want to be because that's the lifestyle or the demographic that you feel like is calling you to be your home, what do you do? Just throw up your hands and go rent?
Yeah, no, that's definitely the question, and I don't think renting is the way to go because what I'm seeing with a lot of renters is they're moving to a property, and after a year, the clients are saying, "Well, geez, I can get this much for my property. I think I'm going to go ahead and sell it." So they'll give them their notice to move. Seeing that a lot, actually, and where people are saying, "Well, I just don't want to. I'm done with renting. I'm just going to sell it." So these renters are hopping from property to property, and the affordability rate here where I live is we are the highest in the nation. So what's the option, right? If you're moving and you can't afford a detached home, you're going to try to buy a condominium or a townhouse. If you can't afford that, where are you going to go? Well, there are some other options, and I know that we've talked about that before. Um, I am a Redfin associate agent, which means I get Redfin leads. That's basically all that means. But most of my leads that are coming through on my phone, and my phone goes off, I probably get 5 to 10 leads a day. And a lot of those are manufactured homes. And so I'm seeing a lot of those leads where people are clicking on a website and they say, wow, okay, I can get a manufactured home for this much, so that's a conversation that we need to have.
And that conversation continues throughout the coastlines on both sides of the nation because at this stage, what the manufacturers have done, which is very wise, is they've paid attention to the trends and they've started to develop manufactured homes that, frankly, look equal on the inside to brand new homes. And so they've really leveled up the quality of the construction of these manufactured homes. What we're seeing in California is that before, the manufactured home areas or mobile home parks were places people would go upon retirement, or if they were going to stay a short period of time and knew that they were going to be moving and have the ability to park their trailer and then keep on going. But now we're seeing that these manufactured home parks are truly becoming the entry level housing to many of the communities on the coastline. And I believe the stigma of the past of mobile homes or manufactured homes will fade away very, very quickly for two reasons. One, there are parks where you can own the land. Other parks, you have to lease the land, but there are now parks where you can own the land. So there's home ownership there. And as I mentioned, because of the quality of the construction and the diversity of these manufactured home builders, this gives everybody an opportunity, regardless of what price range that they're at. And so what we're seeing is, and we are, full disclosure, we are a dealer ourselves of manufactured homes. And so we know those manufacturers and we have the opportunity to help our clients and our investors to invest in the manufactured home parks. But there's different levels, very similar to home builders, different price points for everybody. And if you're leasing a plot, we can deliver these homes for typically around $250,000. And so for us to deliver something at that price compared to a single family home that's 3 to 4 times that price, it provides incredible value for the customer or the investor. Gary, what are you seeing with your clientele when they have to consider transitioning to a manufactured home or a mobile home? Are they open to that conversation, or do you still feel like there's some level of a stigma that is around that part of the real estate market?
Yeah, I think that stigma is starting to go away when people are seeing that may be their only choice. And then I believe that it's going to be location of these parks. And I did look at sales comps the other day of different parks, and some parks you can get a full home for $250,000. And other parks are a little bit more luxurious. Maybe they offer some more amenities that other parks don't allow, or it's in a better location, and you'll see that price may double. But if you look at the inside of these homes, if you're looking online, you can't tell that from a regular detached home. These manufactured homes, they've really made it hard to distinguish what you're looking at if you're looking at a picture. Because you look at some of these kitchens and living rooms, they look, fabulous, and they've got wood floors, and the kitchens look like it's a gourmet kitchen. So um, I think that stigma is going to go away real fast because people are getting priced out of the market, and they have to go somewhere to live, and renting is definitely not the way to go, and people are figuring that out really fast.
Yeah, when you look at the landscape, you have a few different options. As I mentioned, land owned versus land leased. And then you have a significant amount of communities that are 55 and over. So this is great for seniors who want to sell that single family detached home. They want to downsize and they want to possibly pay cash for their property. And if it's land owned, again, they don't have the lease fees, because those lease fees can be quite expensive. They can be anywhere from a few $100s a month to all the way nearly $1,000 a month. So be conscious of that if that's of consideration for your client or an investor. But what I believe is about to happen, and we did see this in the 1970s when there was a lot of inflation. One of the things that you have to go through when you become a dealer of manufactured homes is you have to go through the history in California of how it all came to be. And it's a fascinating history. The summary is simply this, is that people that were migrating to California during that period of time, and even, years back, even all the way going back to nearly the gold rush, they were squatting on land at the end of the day, and they were bringing their items, their things, their households with them. And so there had to be some formalization of these communities. And as we all know, back in the day, they were referred to as trailer parks. And so, with the reformation of the mobile home parks, when the rules, the regulations, they refer to it as the chattel, started to be taxed, and they started to build out these communities, they essentially made them very similar in regulation to what you see with apartment buildings, for example, where with a certain size, there needs to be a resident manager. There has to be rules or an HOA that's governing these plots of land. And like anything else, they take on their own evolution. And what I believe will happen if the prices continue to rise at the pace that they are because of the inflation is you're going to see some of these communities, especially the ones that are coastal near the beach, because there's some fantastic communities that are very close to the water here in California. Same with Florida, same with Texas, same with many other parts of the US. Is you're going to see investors going in and redesigning these parks. We're not going to be able to do as much with the 55 and over because, in my experience, seniors don't like that much change all at once. However, could be. I'm not saying it can't happen, but I would imagine it's the all age parks that are going to experience this. And once the amenities start to develop and the community starts to develop to attract the younger generation, I wouldn't be surprised if this becomes the next hot ticket. Because if I have to choose between a high rise that has very little parking, very little outdoor space, and a dialed in community that's near the beach, that has land that I can own, that's in proximity to multi-million dollar properties, yet I'm purchasing at a fraction of the price, and I can purchase a brand new unit, a brand new manufactured home that has all the aesthetics of a home, yet it's smaller. Many times they're about 1,000 to 1,500 square feet. There's a lot of value in that. And that's the trend that I'm waiting for. I haven't seen it yet. I have seen a lot of affordable housing movements with these, grand visions of creating containers into homes and tiny homes. We've all seen that movement, but we haven't seen it come to the manufactured home parks yet. And I'm looking forward to that day. So, Gary, when you talk to your clients that are priced out and you bring up the idea of a manufactured home, are they even aware that they could potentially purchase brand new?
Not at all. No, most people don't even think about that because they're thinking, well, manufactured home, this is a 55 and up, community. They don't even know. I mean, a young couple could get a home for the low 200,000s in a really nice park and have a place for their dogs. If you're renting and you've got animals, well, good luck trying to find a rental. Most rentals don't want animals, nor do they even have a space for you to barbecue or to have a little storage area. So this may be the new trend. This may be the new wave of the future, and of course, it's good that we're in line now and ready with this. This could be the new wave for California. We'll see.
And there is a flip side to every coin. So I want to be transparent and share the other side of the coin, meaning the challenges of obtaining a lot in order to put on a new manufactured home. If you're in a state that has lots of land, I believe you're going to start seeing these communities pop up and you're going to see plots of land being sold off or the brand new homes being installed. And it will be no different than when you show single family homes, brand new homes. You'll have a model, you'll have a tour, you'll have a few to select from. And the way that these can be turned around within 60 days or 90 days is quite nice because you're not waiting 8 months to move in. But in Southern California, especially, or other tight markets across the country where there is not land that's available, you're dealing with parks that already exist, and you're going to have to find an older property where you pull out the existing manufactured home and then install the brand new one. So when we talk about the cost of the new manufactured home, you need to also add in the cost of purchasing an existing property. Now, in California, you can do that for less than $100,000. And again, the cost of the actual new manufactured home installed, and I'm using round numbers here, so please don't quote me specifically because custom upgrades and floor plans and the size all determines the final price. But let's just use a round number at $250,000. And then let's say it costs you $100,000 to purchase an existing plot and pull out the property. Well, now you're in for $350,000. Well, that is significantly less than what you would be paying for a single family home. Now, these are on land leased properties. If you're going to own the land, well, that property is going to cost you more when you acquire it and pull out that existing property. So just factor all that in. But the bottom line is you're looking at 20 to 30% even 40% less than what the average single family home would cost, depending on the market territory and the supply and demand. So it does provide a significant discount. What I would encourage for anybody who is interested is to reach out. Reach out. You can reach out to one of our specialists here, or I'm sure you have one in your local community. You probably know about the manufactured home dealers. They're typically in the same areas where you would go to shop for an RV or car dealership. They're potentially going to be in those areas, and you can go and visit and take a look for yourself at the model homes that they have on the lots. And I can assure you, you will be impressed with what has happened in this last decade. So Gary, let's coincide this with our earlier discussion about interest rates and affordability, because one of the challenges people have is financing manufactured homes. A lot of manufactured homes are paid for in cash, but there's very few lenders out there who actually finance these manufactured homes. Good news is, if you're working with a dealer, that dealer typically is going to provide financing or will have the connections to the bank to get financing. But those rates are even higher than what we're talking about here in the single family home and residential market. So I want people to be prepared for that and not be discouraged when they go in to figure that out on their own. Have you encountered any of your clients doing any creative financing when it comes to purchasing these homes? It's not hard money rates, but it's certainly higher than the average mortgage rate. What are you seeing out there on the front line?
Yeah, it's almost the same as buying land. Like here in California, when you buy land, it's either cash or there's one bank that does it, maybe possibly two banks that will loan you the money at a little bit higher interest rate. So it's the same thing with manufactured homes. And normally, if you let's say you find a manufactured home and it was listed on the MLS, usually that agent will have a dedicated lender that they've worked with before, or that works in that park. Because normally, you don't just buy the home and get a loan and get in. You do have to go through that particular park, and you do have to be approved by the park to buy that home. So there is a caveat there. And normally, if an agent has sold in a park before, you'll see it in the confidential remarks that will state, please fill out an application for that park before you look into a loan or before you buy into the park. So that is one stipulation, and you do have to be aware of that.
And I would encourage people to take a look at FHA because FHA does loan on manufactured homes. They do have their own requirements, but that's another way that you can break in. It's just not as convenient, and there's not as many loan officers out there that are going to be ready to provide that loan because they may not be set up to do so. So this will require a little bit extra effort on either the agent's part to connect that consumer with the right lender, or if you're a listener and you're out there considering investing or purchasing, for a flip, for example, that's going to be much more challenging because FHA is going to require that this is owner occupied, and they will loan on leased land as well. From what I understand, you can do your own due diligence. So it's not mandated that you own the land, but I do believe it is mandated that it's owner occupied. But the bottom line is, like anything else, when it's easy and everybody knows about it, well, then the market's usually already spoken for. But when it's a little bit more challenging, a little bit more niche, then that's where the opportunity arises. And that's where we see tremendous opportunity all around in the near future. I want to touch on inflation real quick because this is something that is not only eroding everybody's pocketbook, but it's also affecting the housing market in general. The speculation was that as interest rates climb, housing prices would come down. Well, that did not happen. And unless we get a deep recession or some upheaval in the stock market or some significant geopolitical event, even though we've already had several, we are not going to see the level of depreciation that people anticipated. And anything can happen. I may come back 6 months or a year from now and say, well, everything's changed now. This happened. And therefore, we're seeing a lot of recession as far as real estate prices. But let's just for one moment assume that real estate prices are going to hold on the residential side and keep up with inflation. Because ultimately, what you're trying to do with real estate investing is you're trying to beat inflation. It does you no good if your property goes up 10% and then inflation creeps up 8% that year. You really only got ahead 2% at the end of the day. And so, where people are right now thinking, I'm going to wait because property is too expensive or interest rates are too high, that very well could come to bite them in the butt coming up here. Because if you look back at decades like the 1970s or even the 1990s, where we started to see higher than average inflation, that typically was a trend and a multi year trend. And by the end of those decades, the average price, whether it was cars, housing, goods, groceries, whatever, was significantly higher, sometimes double or more from the beginning of the decade. So when you think about that, it's not so much about the interest rate today as it is what is this going to cost me 5 years from now or 10 years from now? And if we just simply assume a higher than average inflation rate, let's call it 5%. I know the Fed loves to be down at 2 or 3%, but let's just call it 5 or even 6%. Well, there's this little mathematical equation you can look up online. It's called the rule of 72. And with 6% inflation, for example, that means prices will double every 12 years. Now, you know, and I know these government numbers are somehow completely off from reality because I don't know about you, but when I go to the grocery store and I pick up a steak or I pick up some other groceries, I am quite confident that it is more than 5 or 6% as far as the price tag from what it was a year ago. I've noticed things doubling or even tripling. So you have to keep that in mind that if that came to pass, which we've already seen post pandemic, we've seen properties double in value. And although people think, well, that could never just happen again, well, it could happen again with the right amount of inflation. So don't hang yourself up on the interest rate, is what I'm saying. And I understand there's payment. And if you can't afford the payment, don't get yourself into something that's going to drown you underwater. That's clear, hopefully. But if you are able to lock yourself into a property, you are actually locking yourself in to beating inflation over the long term. So this conversation will become more and more important if inflation sets in and roots itself in for a multi-year trend, which it looks like it's doing. So Gary, when you have your conversations with your clients, and I'm sure everybody's complaining about inflation, right? That's normal right now. No one likes the cost of goods for everything that they purchase going up. But is there any documentation that you're providing? Is there any information that you're sharing about the future of inflation? No one has the crystal ball. We don't know exactly what's going to happen, but really an explanation to the client of this inflationary environment and how real estate is actually a hedge against inflation.
Well, Andrew, I've been doing this for 20 years. Most of my clients in the past, I usually get a phone call about every 5 to 6 years that says, "Hey, I've just made a lot of money on my property. I'm ready to either move to another property and move up, or I'm looking to move out of the state, or this is my favorite, is I'm ready to buy more property, keep this one as a rental." So I think as far as beating inflation. Most of my clients have already done it with the property that they've purchased in the past. And certainly you could put your money in the bank, but most of my clients have been living in their investment. They've made money on their property over time. So instead of putting your money in the bank and not, making 5%, they've made probably 10 to 15% on their income based on their property that they purchased.
Yeah, it's incredible when I think back. I arrived in San Diego in 1995, so I'm coming up on 30 years here, and I was raised in the San Francisco Bay Area, which is probably the case study for real estate inflation. It's staggering what's happened in the San Francisco Bay Area. A lot of that has to do with the technology industry in Silicon Valley driving up the prices because so many of the employees of the companies that have become trillion-dollar companies were granted stock options and incentive packages that in turn drove up the local real estate market. But even here in San Diego, which was somewhat of an ignored market for many years, it's not anymore. The secret's out. Everybody knows San Diego, best weather in the country, high growth, wonderful lifestyle. And I've got biotech and a lot of different diversity in the industries that are here. But when I arrived in 1995 and I started to sell real estate later in the 90s, you could purchase a single family property for around 250,000 or 300,000 at tops for just an average property. Today, that same property is nearly $1 million. So you're talking about a 400% increase. Now, remember, this is through thick and thin, right? We had 9/11, we had the 2008 crisis, we had the 2020 pandemic. So you had a lot of recessions and fallout throughout that journey. But if we just think about that rule of 72 that I mentioned, okay, 3% inflation would mean that every 24 years, your property or the price would be doubling, right? 3 times 24 is 72. And so over the last 24 years, instead of it going up 100%, according to the rule of 72, well, to Gary's point, I mean, it's gone up 400%. So when you start factoring in those numbers, well, now it's more like 12% appreciation. And that would mean every 6 years, your property's doubling. And that's why over the last 24 years, it's doubled 4 separate times. So when you're sharing with your clients about the future, again, no one has a crystal ball. If the last 5 years hasn't taught you that you can't predict what's going to happen next, well, then you should stop speculating altogether because I don't think anybody could have predicted that the world was going to shut down 5 years ago during COVID. But here's the explanation I would be having with my clients if I was in the field today. I would present the facts, which, regardless of what state you're in throughout the country, we've experienced significant growth in almost every single city. You can go back 20 years, you can see what that price was 20 years ago and what the price is today. And odds are, especially given this boom we just all witnessed, you are going to see much, much more than 3% increase year over year. And look up that rule of 72. It's one of the most helpful things that's helped me in my investment career and also analyzing assets and what their true appreciation is. And once you have that and you can present that yes, the federal government's saying that our inflation is only 3, 4, 5%. And now they're trying to get it back down to 3%. But the reality is real estate has always outpaced inflation. And if you can demonstrate in your local market that on average, through thick and thin, it has been at 6% or 10%, or in our case in California, over 12%, well, then it just makes a lot more sense to people to buy into a market when they see the high interest rates, when they see the high prices, because you're looking at it from the long term. Now, if somebody wants to buy and sell within 2 or 3 years, well, you don't know that outcome, and you shouldn't claim that this is a foolproof theory, but over the long term, this has been proven over and over and over again. There's a couple periods in history, like the 1930s, and when we were at World War II, and a couple other periods, very short periods, for a 4, 5 year period up to about a 10-year period, where that didn't work. Yeah, if you bought the top, you took a bath. If you were long, you were wrong. But for the long term, for those who have held on and turned their properties into rentals, they look back now and say, wow, I have outpaced inflation by a long shot. I've got this great cash cow yielding me income. And if I had hesitated and not purchased during that period of time, I'd really be kicking myself right now. So hopefully that helps you with your conversations, because I know it's a very tough economy and it's very challenging to get people to wrap their mindset around high prices, low inventory, and high interest rates. So as we wrap up, Gary, any other thoughts or things that you want to share about affordability, inflation, and how to help the real estate professionals that are listening be able to execute in this challenging market?
Yeah, I'd say stay close to your clients. We're all in the same situation. A lot of us can't afford the homes that we currently are living in right now. So, but real estate still is the answer. It is still the best investment, I believe, or I wouldn't be selling it for over 20 years. So save your money, look for other options. Andrew mentioned FHA. It's a great option, 3.5% down. A lot of people don't even know about it or think about that. But when you're looking for a home, there are options. You don't have to live right on the coast. You can go east. And if you don't have a coastline, it's always location, right? Next to a lake or a golf course. But start out, look for that first property, talk to your lender, get a great lender, get a great real estate agent, and have those conversations if you're a real estate agent with your clients that are looking into the future. And well, I'll just wait. Well, maybe waiting isn't always the best way to do it. But if you've got the money now and you can purchase a property, show them the best way to do it, and sit down and have a conversation with them.
No, it's great advice. And as we wrap up, there's an old adage that we've all heard, and it's buy low and sell high. And I have done that in market cycles. And now, when I reflect back over 25 years, I've got rid of that in my mind. It's no longer buy low and sell high. It's buy low, but then hold high and buy more, and do it again and again and again, and accumulate as much as you possibly can in the form of real estate assets that will provide you regular, consistent cash flow. And if you can provide that game plan to your clients and they can become investors in their own right, you will continue to generate transaction after transaction after transaction. As I like to say, the greatest real estate professionals, especially on the residential side, if they really do their job right and you truly find a perfect home for that clientele, well, then they'll never need your service again. So where do you go from there? Well, you open up the door for investments for your clients. And I know the numbers are challenging right now. I know it's not easy to make things pencil, but take a look at niches like manufactured homes. Take a look at where the trends are going. Figure out with what down payment or in cash, what would be necessary to yield the income that your clients would need. And you can even consider things like syndication, grouping people together so that you can oversee and manage those investments and provide that monthly income to the clients to beat inflation. That's the name of the game moving forward. And we're going to continue to produce and distribute great content, how to beat inflation in the decade to come.